Hello and good morning, everyone. I trust you can all hear me, but welcome to our webinar. My name is Oliver Tregoning and I'm Head of Marketing at JM Fin. And I'm delighted to see so many people have joined us this morning. Many of you will have attended our conferences over the years in person. And whilst I'm sad I can't see you this year, this digital event does give us an opportunity to engage a much wider number of people. So definitely a positive to take from the current gloom. In the spirit of being upbeat, I'm delighted to say we've gathered 4 external speakers to look ahead and give us some insight into what's really exciting them for 2021 and beyond. After them, we'll hear from James Ayling from our research team, who's going to try and put some of their thoughts into perspective from an asset allocation viewpoint. But before I hand over to our first speaker, a bit of housekeeping, if I may. All delegates have been placed on mute, and if you do have a camera on your laptop or PC, it is not in use, so don't worry, we can't see you. If there are any questions that arise from any of the presentations this morning, please send them to your investment manager in the first instance, or if you wish, to our email address marketing@jmfin.com. Alternatively, the chat function, which you will find in the bottom right-hand corner of your screen, is enabled, so you can send questions in the present if you need to, and I will collate all of those and get answers to you post the event. We're not going to have a live Q&A function in the interests of time this morning. In the top right hand of your screen, if you hover over with your mouse, you will see that there are some alternative views that you can select. I would suggest that you choose the active speaker view, but feel free to switch to whatever works for you. Finally, we are recording the session and it will be posted to our website within the next 48 hours. So if you miss something, don't worry, you can go and have a look at it in your own time. Now, I'm delighted to hand over to our first speaker this morning, Hugo Benford. Many of you will know that Stephen Sussman, our current chief executive for many years, is standing down at the end of the year. And we're all delighted that he will be replaced by Hugo. Hugo's been with JM Fin since 2006 as an investment director, and for the last 4 years as co-head of our London office. So to give us some insight into the challenges that lie ahead for him and for JM Fin, I will now hand over to Hugo. Hugo.
Thanks, Ollie, and good morning, everyone. It's great to see so many people joining us, and a very big thank you to all our guest speakers. We really do appreciate them giving up their time this morning to share their views and insights. Just to let you know, I have put a do not disturb sign on the door, but apologies if I get interrupted. As Amazon's customer of the month in November, there is a chance that happens. I'm not going to spend time looking back over the last 9 months, but in the spirit of focusing on the positives today, I do want to say a huge thank you to all our staff for the way they have responded over the period. In the space of just a week in March, we moved out of 6 offices into over 300 new home sites. And a number of teams and individuals stepped up and have continued to work very hard to ensure that we've been able to operate with very little change. We are a people's business and have placed great emphasis on ensuring our staff have felt secure, engaged and connected, so that in turn we hope they have been able to look after clients in the same manner. And whilst others in the industry have struggled, we are proud of the fact that we have not furloughed anyone during this time. The other bit of good news is on investment performance. Looking at the aggregate numbers, it's clear to me that we have managed to protect client assets in the face of quite a serious market setback. With the FTSE All-Share down around 14% for the year to the end of November, our discretionary clients have, on average, moved up 2%. And whilst we don't generally celebrate a 2% return, this does reinforce our belief in active investment management and helps us in our long-term goal of capital preservation. So looking ahead, what do I think the future holds for JM Fin? Well, my own team have always been pretty quick to remind me that there is still plenty to learn in the art of investing, but I think we have been able to learn along the way about what clients want and, probably more importantly, what they don't want. My overriding sense of what works is the very nature of what we do. which is to allow investment managers to be investment managers, to have direct responsibility for their clients' investments and to carry the accountability that comes with that. We believe clients like to speak to the person who is actually managing their money. And this is how trust is built. And we appreciate it does take time, but the benefits are clear to see in the relationships that we have with clients that last through generations. From the investment manager's perspective, understanding the impact of their advice, the tangible results that come from them, such as helping a grandchild to get on the property ladder, that's what makes the job fulfilling. So any growth or strategic plans that I may look to oversee in the coming years will not compromise the service our clients are getting today. And interestingly, I think this focus on service is increasingly differentiating us. And because of that, we are seeing high quality managers looking to join us from other firms. And what about growth? Well, new business is often seen as a dirty phrase, but the fact remains firms like ours have to grow to continue to be able to invest back into the business and remain in a strong position to weather uncertain economic and regulatory times ahead. So we're not looking to double in size overnight, but rather to continue to increase funds organically and by bringing in the right managers who fit our culture. James Edgedale and Stephen Sussman have done a terrific job in growing the firm. And along the way, we have retained what has become an increasingly unique structure, I think, of having client-facing investment managers involved at the highest level of management. It's been mentioned to me on more than one occasion, actually, that this is a challenging time to be taking the reins, and I agree. But I think it's also a great opportunity to reflect on what we can improve on and what we can aim for as a business. Robo-advice has been on the rise in recent years, and I think the pandemic has highlighted the difference in our more traditional approach versus the newer challenger brands. Yes, they do offer cheap, easy to market, but when volatility and uncertainty pick up and sectors diverge, purely passive strategies often leave clients, I think, with little to control to protect their investments. And the evidence is that clients have missed the opportunity to speak with a manager. As a firm, we have a very long history of looking for companies of the future to invest in. And more often than not, I think these fall outside of the very biggest and best of today's selection. It's in our DNA to understand what we're investing in and not simply to follow the crowd. And so looking to the future, we will continue to meet face-to-face or online, as we have recently, with the management teams of the companies and funds that we're interested in for our clients. We realize, though, that some of these new platforms are doing a good job getting people investing, and we need to adapt what we do to get the best of both worlds. Looking at millennials now who started work during or soon after the great financial crisis, then lived through austerity, and now feeling the effects of the pandemic, saving for their pension is probably not a priority at the moment. We must make sure we have the right services to help those people who want to start small or start early. We have a unitized portfolio service, Coleman Street Investments, which can be ideal for younger investors. Its performance is excellent, and we're looking to make it even more accessible and relevant by enabling some self-service investing and making the whole service fully digital. And that's also why one of our big focuses for the future is wealth planning, helping our existing clients with their wealth transfer challenges and pension planning. As we enter a period of likely higher tax levels, subdued growth and low interest rates, planning and wealth structuring are likely to be key to long-term financial security. We started giving wealth advice at the end of 2016 and built it out in the JMFIN mold of being needs as opposed to product driven. So rather than operating as a separate division, this is something that we offer to our clients as complementary to the investment management, and it's becoming a fundamental part of the firm's business. The next step for us will be looking to introduce more access to wealth planning in the branch offices. Another aspect of investment that's becoming increasingly important is the need for more responsible investment management. There's been quite rightly a tremendous amount of news coverage on environmental, social, and governance investing, ESG investing, particularly in light of the pandemic. At present, the debate is slightly weighed down by a plethora of often diverging definitions and considerations, but I really do believe that we need to make more ground here, and not just for our future investors, but for our investors of today. The most successful companies of the future will be able to demonstrate their purpose, what they contribute to society, and their impact on the environment. And so we need to deepen our engagement with these companies in order to unearth the best investment opportunities. And on this theme, we have seen a big shift towards paperless reporting over the last 12 months, and this is where we want to lead the business. We've recently carried out some great upgrades to the website, portal, and app. In fact, I've just downloaded the new app this morning, and we will continue to keep making these work as intuitively and reliably as possible. Elsewhere, we've been working on our diversity and inclusion initiatives, as it's plain to see that a well-functioning business allows everyone the opportunity to contribute. Our focus has been on diversity to date, but as our effort has broadened, so we've realized we do need to do more around inclusivity. This is very much on my agenda, and I look forward to working with our team here to bring new initiatives to the fore. In terms of our overall structure, our regional branches continue to thrive. Bristol, which moved into a new office during lockdown, which was another IT achievement, Leeds, Bury St Edmunds, Cardiff, and now Winchester, which we opened in 2019, are all performing really well. Clients tell us how much they appreciate the local access that this gives them, and we continue to believe there is a really important role for these offices to play in the local communities, particularly as working patterns change. After 13 very happy years at Coleman Street, we will be moving our London office at the end of next year. We are going to be staying in the city, and we're really excited about being able to create a more contemporary working environment. And like other businesses, this has given us the opportunity to look at the working lives of our staff. Whilst I'm a believer in the benefits of more flexibility, I think the perks of home working are largely lost when there is no office life to go with it. So our aim will be to find an approach that blends the benefits of the office with a more agile approach to working from home, and one that works for clients as well as staff. Next year will mark JM Fin's 75th anniversary, and I feel incredibly honoured to be able to play a part in the next stage of the company's long and successful journey. There's plenty to be positive about, and I'm really looking forward to getting started in January. Before I sign off, it would be remiss of me not to mention the B word. Like others, we are fully prepared for a no-deal Brexit outcome, and with our focus very much on UK investors, we see very little impact on our underlying business. Responding investment strategies are another thing, however, and I know James Ayling will be giving some investment thoughts on this in his talk today. I want to end by thanking you, all our clients and our counterparties and intermediaries, for the loyalty and understanding that you have shown us over many years, and especially over the last 12 months. We really do appreciate your support. And on that note, I'd like to pass back to Ollie to introduce our next speakers, who will continue, I hope, the theme of looking ahead.
Hugo, thank you very much indeed. And now I'd like to commence with the first of our guest speakers. First up this morning, we are very fortunate to have Paul Major join us. He's a fund manager of the BB Healthcare Trust, which is a high conviction, long-only investment trust investing in global listed healthcare equities. So Paul, as well as looking at the secular growth story that is healthcare, will also share his views with us for the pandemic. So if you just bear with me, I'm just going to share my screen. And then Paul, over to you.
Thank you, Oliver, and good morning, everybody. Hopefully you can hear me okay and you can see the slides in front of you. So as Oliver said, I want to talk about 2021, the wider market environment, and really the question of how healthcare might fit into that. So looking forward to 2021, I guess it's really a question of animal spirits. As we look forward, are you a bull, excited about the market? Are you a bear, fearful? Or are you a donkey? I'll come back to that less familiar third epithet in a while. I'm not going to spend too much time talking about our fund beyond a brief overview. Your JM Fin advisor can give you more details on the fund. Equally, I won't go through everything in the slides because Oliver has already said that the material will be made available afterwards. Oliver, if we can have the first slide, please. So firstly, I just want to say a few words about healthcare. Simply put, this is the secular growth story of our age. I can say with absolute certainty that every single person on this call, willingly or unwillingly, will be a consumer of these services over the coming years. If you look at it from a driver point of view, there are three extremely strong drivers of growth for healthcare. There are ever more people, they are ever older, and the world is getting wealthier all the time. Once you see countries move into that middle income bracket, then you can see they spend more on healthcare. Once you have food in your belly and a roof over your head, you worry about staying well. You can see that spend is heavily skewed to the later years of life. And so what we see then is three visible drivers of growth well into the future for many, many decades to come. Next slide, please, Oliver. Now, the picture that Oliver has just shown you is a hugely compelling one, but there's one small problem with this, and simply put, it's that society can't afford any of it. So you can see two charts on the slide in front of you, one showing you the inexorable rise of healthcare spending in the US, and the other putting it into a context around GDP. And simply put, for many, many years now, healthcare cost inflation has exceeded GDP growth, and that is set to remain the case for the foreseeable future. So simply put, if we don't change course, if we can't bend this cost curve that we see in front of us, one of two things is going to happen. The healthcare system is going to collapse in on itself due to a lack of funding, or alternatively, healthcare is going to consume all of our marginal wealth creation as society moves forward. Now, this sounds like a very depressing picture, but I have some great news for you as a member of society, as a taxpayer, and also as an investor. And it is this: there is a very different way of delivering healthcare, and the tools and services to enable that to happen are with us now. And it's into those that BB Healthcare invests. So we see a very different path over the longer term than the one that you might conclude from extrapolating these slides. Oliver, next slide, please. So this is just really a summary of our investment strategy and the results that has delivered. I won't go too much on it other than to say, hopefully it gives you a clear impression that we have a scalable strategy focused around this healthcare change paradigm. We like to be judged on rolling 3-year results, and the box on the right also hopefully shows you that the results of this strategy speak for themselves. We firmly believe that change has to come to healthcare, and really echoing a point that Hugo made a moment ago, we think the companies that will deliver that change are not the ones that have led the healthcare industry over the past couple of decades. So really, if you want to benefit from this, you need to have a focused and active strategy seeking out those best-in-class companies, because they're not the obvious ones that will dominate the historical benchmarks, the kind of things that you will get exposure to through a passive investment strategy. And we think that's what active investing is all about, really, finding the best companies, balancing risk, and creating a portfolio that most benefits investors. Now let's move on and focus on the outlook for 2021. But let's proceed with a very quick review of 2020. Next slide, please. So I think you'll all be painfully familiar with this chart. As you can see, the year started fairly benignly, but then as we moved into the middle of February and through to late March, we had a significant market sell-off. These are global indices, by the way. This isn't the UK market. This is the overall market. We had a significant sell-off as the scope and scale of the pandemic came clear. And I think really by the middle of March, it was pretty clear that things had gone too far. We actually highlighted that we thought there was a significant opportunity around the 20th of March. However, we could not have foreseen that there will be such a rapid recovery, even as the wider economic outlook worsened and the pandemic gained momentum, a momentum that is still with us now. Healthcare exhibited classical defensive growth characteristics during this, i.e. held up better than the market as sentiment turned over and the market fell. That's exactly what you'd expect. People get sick whether the economy is growing or shrinking. So this is a classic defensive demand story. One thing to say on that, though, is it's all very well to talk about healthcare being defensive, but we have to think about the supply side of all of this. So the physical and temporal distancing measures that we've all had to become familiar with over recent months apply probably even more to the provision of healthcare than they do to going to a restaurant or going out shopping. If you're COVID wary, then people are very happy to defer visits to the doctor or the dentist as much as they are to not go to the cinema or anything else. And it's worth bearing in mind that around 85% of the value in healthcare is in what we call the elective bucket. So these are things you can elect to do, you can choose to defer. And we saw a significant amount of that deferral going on in the early part of the pandemic. And that's back as a significant factor now because many people are tantalisingly close in their own minds to getting a vaccine, so they're happy to again go back to deferring visits to the doctor. So although we were bullish back in late March, what happened next was not what we expected. We didn't think that by the end of April, healthcare indices would be back to where they were before the sell-off. So even as the sector couldn't operate at full capacity, and even as the market was even more expensive, because in the wider economy, of course, we'd seen downgrades to growth forecasts, we'd seen economic outlook worsen significantly. If you look at the market overall, again, valuations reached record levels in the immediate aftermath of the pandemic. And again, market indices recovered to historical highs. Now, we could debate all the reasons for this all day, fiscal stimulus, negative real returns from fixed income, and a market that evolved. So the dynamic of the market shifted much more toward things like home working and very strong leadership from tech, which I'm sure you'll hear more about from one of the other presenters in due course. So simply put, we had a very rapid recovery, and then we had, over recent months, a very quick move toward a sort of post-COVID outlook for the market, whether or not you think that is justified. Vaccination is clearly a reality now, so I'm sure you've seen the news this morning. The first person ever to receive a vaccine, COVID vaccine, outside a clinical trial in the West happened today. It was a 90-year-old woman here in the UK. And this is really, the build-up to this has really cemented this narrative of back to normal, reopening, discussions of life after COVID. Now, if you accept this narrative is real, if you believe that we are tantalisingly close to a return to normal, then there's an argument that says you should back up the truck and you should fill your portfolio full of risky stocks that are linked to that economic upswing that's likely to follow. At the same time, we can't ignore the fact that market leadership is very narrow, it's very tech-led, and long-term metrics of valuation are at all-time highs. So in a normal environment, in any other time, we'd be looking at that market leadership, we'd be looking at things like Schiller PEs, and we'd be saying this market has some definite red flag warnings in terms of the outlook. So here's the question then, for you as investors, and not just with regard to healthcare. What do I, as a healthcare expert, make of all this stuff about vaccination and the chances of life being back to normal after Easter, which is what Matt Hancock said only a few weeks ago? Next slide, please, Oliver. Now, I'm sorry to say, many of you are probably not going to like what I'm going to say next, but it is what it is. So we don't really see things unfolding on a Matt Hancock timescale. Probably not the first time you're going to hear somebody question the comments coming out of the government around the pandemic, but there you go. There are a number of reasons why we are less optimistic, perhaps, than the health minister, and it really comes down to the question of what are the parameters under which the government thinks it's okay to start to roll back the restrictions under which we're all living. It's probably going to be linked to the level of hospitalisations and deaths that are deemed acceptable by society. Now, presumably that is a level significantly lower than where we are currently. Now, we know that COVID is a serious risk to a small and well-defined minority of the population, principally the elderly. If we manage to vaccinate that group of high-risk individuals, then morbidity and mortality should fall fairly rapidly afterwards. If you look at the data, 77% of the deaths in the UK so far have been in the over 75 category. So you could rationally argue that once you've vaccinated this high-risk group, then the risk to the rest of us is manageable in theory, and we can move forward. There are only 4 million people in that over 75 category, so that sounds like a reasonably easy thing to do. However, I think COVID has probably one of the best PR machines I've ever seen, and nothing spreads faster than fear, including any virus. And it's very clear that this is a disease that is feared by a much greater swathe of the population than the risks would suggest. You only have to recall going out for your constitutional exercise during the first lockdown and walking past somebody with young children and watching them literally throw their kids into a bush lest you go within 2 meters of them. It's worth bearing in mind that the risk of a child dying of COVID is actually less than the risk of a child being struck by lightning. And I think this really highlights a broad point. You know, humans are notoriously bad at assessing objective risk. I'm sure you know somebody who's terrified of flying but probably doesn't think anything about crossing the road every day. Now, statistically, that's a bonkers way of living your life. Crossing the road is far more dangerous than getting on an aeroplane. But we are human beings, we are fallible. So coming back and drawing all this together then, will people really be happy in accepting a rollback of restrictions that begins before we've actually had a substantive proportion of the population vaccinated? Will they want cases to begin to fall, or will they be happy to see that the deaths in that critical at-risk group have been falling? And let's also be clear, we have a lot of evidence that this is a government that's led by popular opinion and is not in any way scared of a U-turn. So what they've said they might do at the moment is not necessarily what they're going to do a few months from now. Now, at this point as well, lots of the experts will be talking about this concept of herd immunity, the idea that once you've vaccinated a big enough proportion of people, the disease will stop spreading. But now this is a proven idea. We've seen this with many paediatric diseases and the success we've had in making things that we'll remember, like measles and mumps, a thing of the past. But the important point here is these viruses have not gone anywhere. They're still out there in the environment. They are endemic. They simply cannot spread as long as you continue to vaccinate enough people, because you've effectively broken down the chain of spread. And what you've done is you've reduced the risk of people getting symptomatic disease. Now, the virus that causes COVID is arguably now endemic as well. It's everywhere, and it's not going to go away. You've only got to look at what happened in Wales. This idea of a fire-break lockdown, it would break down transmission after a couple of weeks and it would enable life to go back to normal. Here we are, less than 3 weeks after the end of the Welsh lockdown, and levels of hospitalisations due to COVID are pretty much back to where they were before. Now, you'll probably also be familiar that measles, a disease that had been deemed to be eradicated, is actually prevalent again in the US. This is because of the anti-vax movement. Now, any disease, as I said, can re-emerge once you get below this kind of herd immunity threshold. It's very, very high for measles. You need about 95% of the population to be vaccinated for measles not to occur. The threshold for COVID is much lower. It's probably around 70%, not allowing for the efficacy of the vaccines. You can see some data on this on the slide, so I won't go into this too much detail. But I think the maths of achieving that level of herd immunity is going to be extremely challenging, and that's a critical point. So the notion that we're going to get to March or April or whatever, and cases of COVID are going to dramatically fall seems an unrealistic one. Next slide, please, Oliver. And this comes to an even more important point. We genuinely do not know if these vaccines significantly reduce transmission. I won't go into the science behind all of this. If you're interested in it, you can look at our fact sheets on our website over the last few months. We've gone into some of this stuff in a bit more detail, but it will be time-consuming to discuss now. All these vaccines have been shown to do is to reduce the severity of disease. Now, don't get me wrong, that's a brilliant thing. It's going to save a number of lives. But what it means is you can't preemptively reduce restrictions until you're confident that hospitalisations are falling everywhere in the country. So, even when we get there, even if you're under 50 and you're in the COVID-wary group, you're going to be waiting a while before you get this per the schedule. Will the under 50 COVID-wary population, that's quite a significant amount, it's probably about 15 to 20% of the population in most Western countries are genuinely COVID-wary. Are they going to re-engage with normal life? Are they going to start going to restaurants and bars and holidays and things like that? Especially when they've been told that the prospect of getting the jab is so tantalisingly close. And then we come to the logistics, which is really the focus of the slide in front of you. The effort to vaccinate the population is an unprecedented logistical challenge. Assuming everything goes well, it's an unprecedented logistical challenge to meet the time frame that has been put forward. We've already seen Pfizer walk back on its commitments for vaccine delivery in 2020. It can't scale up production quite as fast as it hoped, and it's just told the US government that it might not be able to allow the US to exercise the option for additional doses that it has, because other countries have actually made firm orders for amounts of vaccine that mean that Pfizer is now going to struggle to meet that demand. So we can be certain that there will be enough vaccine to go around eventually, but we can't be certain about when it will be delivered. Now, the preliminary government plan calls for about 90 million doses, so enough for about 45 million people, to be in the hands of the NHS by April. Assuming that they get all of this and assuming it can all be delivered, that would suggest that herd immunity, in theory, could be achieved by June. That would assume, obviously, everything going perfectly well. I think, coming back to why did Matt Hancock say what he said, I think the high-risk population and the over 65s, you could probably get that done by around February. It takes a month, so probably end of March, early April, in theory, you should start to see the prospect of that significant reduction in mortality and morbidity, hence the argument we can all get back to normal after Easter. Next slide, please, Oliver. Now, when we think about this as well, this is a global pandemic. Whenever you think of the NHS, whatever your experience of it has been historically, we are a very advanced nation when it comes to the provision of healthcare. However challenging this might be in the UK, it's going to be even more difficult in a number of other countries. And I think that the question of vaccine scepticism is going to be more of a challenge in some of those other countries as well. They will serve as reservoirs of potential infection, and I think that's going to mean that rolling back travel restrictions is going to be a challenging thing as well. Now, why does the rest of the world matter so much? Well, it's worth bearing in mind that the FTSE is a very international equity market, stacked full of global companies. So really, the UK economy is not the key to the performance of the FTSE. Final depressing point I would like to make is we have literally no idea how long these vaccines will last for. They simply haven't been around long enough. The first people were dosed in May, so we're not going to know whether or not they last a year until May 2021 at the earliest. Clearly, if these vaccines do not last at least a year, the logistics of keeping everybody protected is going to be very, very challenging. You get into kind of fourth grid analogy of the job is never finished. So hopefully they will last a longer period of time, but again, that's something that we just need to be a little bit mindful of. So next slide, please, Oliver. In summary then, let's wrap this all up. Where does that leave us? I think we get the excitement about vaccination. We get the desperate desire for everything to go back to normal. I mean, we want that as much as everybody else. But right now, that remains more a hope than a reality. There are many technical reasons, as we touched on at the beginning, as to why markets should trade at elevated levels, given all of the fiscal stimulus, given the effectively negative real rates out there. So maybe we can ignore the warning signs that the market might look stretched on some historical valuation measures. It's worth bearing in mind that those market index level parameters are really a consequence of this very narrow leadership of these tech companies that trade on super high PEs. If you X those out, the valuations of the rest of the market maybe look a bit more reasonable. Healthcare, on the other hand, remains reasonably valued relative to those historical norms, and also cheap on a relative basis versus that extended market. So I leave you with a single question then, for you to maybe discuss with amongst yourselves. How much normalisation do you think the market's now pricing in? Are you happy? Are you comfortable with that level of normalisation? And do you think the risk to that is on the upside or the downside? I would love to be a bull. I would love to believe all of this is going to happen very quickly and be very, very successful. But there are a number of uncertainties that I've pointed out, and they cause me to worry. At the same time, I would emphasise this is a transient phase in time. We will get past COVID by mass vaccination over time. So if we look forward 18 months, 2 years, then this will be behind us. So I can't really be a bear. So how would I describe myself then? And we come back to the front page and the donkey. I would describe myself as kind of Eeyore-ish, really. A little bit depressed, a little bit worried, but probably actually everything's going to be okay at the end. I'd just like to finish by saying thank you to Jay and Finn for the opportunity to speak to you all. Please do email if you have any questions, and we'll try and get back to you with answers to those over the next couple of days, as Oliver said. And I'll finish by wishing you all a happy and healthy Christmas and hopefully a prosperous new year.
Paul, thank you very much indeed for that very insightful dose of realism. We're going to move straight on to our next speaker, who is from Polar Capital, which is a regional and thematic investment house well known to JM Fin. Ben Rogoff, our speaker today, runs their technology team, which manage a number of specialist funds and an investment trust. And he joins us today to run through a number of his key tech themes for the future. So Ben, I'm just going to share the presentation with you and then over to you.
Thank you for the opportunity. Yep, I'm the co-head of the tech team at Polar. I've been here for a long time. We're one of the larger tech teams in the UK and the world. And yes, it's been a tremendous year for technology. But I think just to contextualise what we go on to talk about, I think it's fair to say that it really has been a fantastic decade. And it's interesting hearing the world from the perspective of a healthcare manager, but from a tech manager's perspective, really the story of the last 10 years has been about tech disruption. And probably the most powerful slide I have in our deck is here on the left-hand side, which just shows you that really all the progress made by equity earnings since the financial crisis have really been driven by tech stocks. That's growth in what we do, and it's the disruption of other profit pools. And it's ended with an incredible divergence of fortunes. And really an important observation, not least because obviously COVID will be, has proven beyond any reasonable doubt the criticality of technology. But I think people naturally like to bookend things, and so with an asset class like technology or a sector like technology, very tempting to say, well, with the pandemic behind us, with a vaccine available, what next for tech? I think what this chart says is that the technology sector story began well before COVID, will persist long after it, and it's evidenced by this divergence in fundamentals that we've seen. And that is in a real contrast with the late 90s, a period that people associate with some pockets of valuation excess that we see in the market today, perhaps, but a very different starting point to the one that we're in currently. And you can see that here. You know, in 2000, there was a very brief window where technology earnings outstripped the broader market. This time around, we've had a decade-long period of technology fundamental outperformance. And you can see that in valuations where, you know, today the sector accounts for maybe 27-28% of the S&P market cap, but roughly 23-24% of S&P earnings. In stark contrast to the late 90s, when the tech.com bubble saw the sector get to more than 30-32% of market capitalization, but only explaining 13 or 14 of earnings. So a profoundly different starting point for what we're going to go on to discuss. And so, Oliver, if you wouldn't mind flipping on. For anyone that follows our work, we lean heavily on history as a guide for what's coming next. And in our last annual report, we made the argument that said that, well, the pandemic was likely to be an accelerant to technology in the same way that World War II was previously. And for those, you know, that follow that period or know the history of it, you know, huge advances were made during World War II in, you know, the field of medicine, you know, things like mass production of penicillin, immunization of tetanus and blood plasma and EpiPens and all sorts of stuff. In the world of aerospace, you know, the jet engine, rocketry helped us get to the moon. And of course, you know, lots of other stuff, not least, you know, the first digital computer at Bletchley Park. World War II was a huge accelerant for technology trends that were anyway happening, and COVID has proved the same. And so the key business imperative going into COVID has been this concept of digital transformation. Companies needing to look more like Facebook and Amazon to remain pertinent in a smartphone-centric world where Gen Z are growing in the mix and expectations are profoundly different to older generations. And what we've seen during the pandemic, like World War II, is a huge acceleration because needs must. And Satya Nadella summed it up very aptly early in the crisis when he said, 2 years of digital transformation in 2 months. Now, if you flip on, you'll see that transformative backdrop. Sorry, next slide. The transformative backdrop is widespread, and so things like e-commerce, fairly obvious. You know, the online shopping had been taking roughly 1% market share from retail sales on a per annum basis, and then COVID happened, and we jumped from 16 to more than 33% of sales online. For the first time, you know, 20% of shoppers in the UK had never been online were coming online because, again, needs must. You know, cloud computing, despite the fact that IT budgets are falling, has managed to maintain its incredible growth trajectory. And cloud remains for us, you know, the kernel of this cycle. really the backbone around which everything else is being re-engineered. Payments as a theme has broken out. What was an ancillary theme to e-commerce has now become a theme in its own right, because shops are closed, because we've been online, but also because cash is being, cash is being used as a store of wealth by some people, but as a transactionally, cash is becoming far less interesting. Video conferencing, really a market that's never broken out of a very small category, has become synonymous with this crisis. 300 million people a day using Zoom, and obviously lots of other platforms doing very well, very much synonymous with this crisis, and a key, I think, something that will persist long after it. The robotics industry has had a new lease of life. It's a crisis built for robots. Social distancing has accelerated the use of cobots in factory settings, in restaurants, and we're seeing things like electric vehicle mixed materials in cars, also now a driver for robotics. The EV space, obviously a huge beneficiary of the crisis. We saw a more than 50% increase per year over year in European EV sales in the first half of the year, in stark contrast to overall car sales. So hitting an inflection point in EV. And then telemedicine, the idea that you would exchange a physical visit with a doctor for something, technology was probably an anathema before the pandemic. And we've had 10 years of change in little more than 1 week, according to one industry participant. So huge acceleration across the piece as a result of the pandemic. Next slide, please. The natural conclusion would be, well, okay, but we're going to snap back to an old world because we're all miserable with the current one. Unfortunately, history as a guide says not. If World War II was an interesting analog for the acceleration we've seen, so I think it provides us with a very useful template for what happens next. So, excuse me if you will, we step back to 1945, Winston Churchill's looking out on the crowds and celebrating his victory, and then fails miserably to do what David Lloyd George did, but to win re-election. And in fact, he's replaced with a Labour government with a platform and a consensus for social change. That is what I believe is going to happen next, post-pandemic. Rather than a snapback to an old world, I think we're going to see very widespread change occur. And the principal reason for that is that we've proven that new work patterns are possible. This concept of work from home will give way to a broader definition of work from anywhere. And people in my team will be able to quite rightly say, I have worked effectively, maybe more effectively from home than I am in an office. And so I would like a new social compact between you and me, in much the same way that the UK electorate demanded the same from their government post-war. And I think what that means is that we will work from anywhere. That will persist. We may do 3 days in the office, we may do 2 days out. Whatever that mix is, it has huge implications for business travel, for conferences, for any business that has high levels of fixed assets, for commercial property. And we're beginning to see, of course, the beginning of this in deurbanisation. So post-World War II, fascinating, I think at least, the creation of new towns, Peterborough, Milton Keynes, Hatfield, Welwyn Garden City, designed to alleviate a housing shortage, but also take pressure off London. We are seeing the beginnings of this already during COVID, where people moving out of cities into rural destinations. You're seeing it in rural property prices. The creation, the advent of so-called Zoom towns like Sacramento, where people are leaving San Francisco, moving to Sacramento for a better life. And the implications for things like mass transit systems are mind-boggling for commercial property, for pret a manger, for whatever it might be. The history as a guide says that the old patterns of work are gone. After the war, fascinating, the agenda that we saw, social change was about provision of universal access to secondary education in the Education Act of 1948, but also the development, of course, of the welfare state epitomised by the NHS. I believe that this crisis has demonstrated alternatives to the sort of the postcode lottery that is healthcare provision and education today. Where you live has a huge impact on the outcomes for both of those things, for your child's education, for your healthcare, and so on. And I think that we're going to see that profound change. In fact, I think COVID has given us a glimpse of the future in 100 million children being taught from home or Google Classrooms or Zoom as a platform, people being not only educated but using telemedicine, AI chatbots. And I think, truth be told, we're not going back to a world where people would sit in doctors' offices with other sick people waiting to see a doctor when they felt unwell. And in fact, we're moving to this idea of remote provisioning of key services, which I think will have a really big impact on healthcare and education, two areas that have been relatively unscathed by tech disruption over, well, during my entire career, more than 20 years in tech. Other interesting observations might be, the idea that a V-shaped recovery is just wishful thinking, much like our hopes that war would be over by Christmas. V-shaped recovery didn't happen in the UK. It took to the 50s for the UK economy to recover its 1939 levels, in part because of debt overhang. Let's not forget, both the US and the UK will leave this crisis with more than 100% of GDP in debt, and that's not ideal from a growth perspective. And I think we might also be looking, from a long-term perspective, at maybe the peak of US power, Pax Americana, much like World War II sort of spelt the end for British hegemony. Anyway, let's move on. Bringing that to tech, the key is that if you don't snap back, what happens? And the answer is that the next generation technologies that we've grown accustomed to, that have been accelerated during this period, things like cloud computing or digital payments, esports, telemedicine, electric vehicles. These ideas, these new technologies, of course, if you flick on, Oliver, they don't stay new technologies, they just become the default. So cloud computing is just computing, and alternative energy becomes energy. And of course, what this says is that our investment backdrop should remain a very fertile one over the coming decade. On the next page, just a quick reminder, we run about $12 billion across 3 different mandates, but key to our technology approach is this idea of identifying core themes. I'm not going to talk about the products themselves, just the themes very briefly. These themes are all driven, secular drivers, and they've been investment focuses for us for many, many years. Online advertising, proving its criticality with people finding customers direct to consumer, the need to drive traffic. We've got e-commerce we've talked about, payments we've talked about. AI story I'll come back to, but again, just scratching the surface of AI today. The cloud remains the core platform for change. Lots of different ways of playing that, the big guys, but also some software stories. Next slide, please. Software as a service, the idea of software ultimately, these are some of the best assets on earth. We've loved them for more than a decade. Still some incredible agents for change, wonderful business models, over-the-top digital entertainment, factories of the future, and then lastly but not leastly, 5G and in there, electric vehicles and other endpoints that will over time evolve into things like autonomous vehicles and other intelligent agents. The idea of the portfolio is ultimately, on 21, please, is the idea that our portfolios give you a diversified exposure to those themes, and as these squiggles hopefully demonstrate, we move money between them as we see the best risk reward or the best opportunity sets. And so right now we have more than high exposure to things like mobility and 5G. We have a high exposure to some of the digital entertainment stories like Spotify, Netflix, and the gamers. And we've been disallocating from some other areas like, for example, software, where valuations are at cycle highs. Next page. Quick, just touch on valuations quickly. Again, I've already referenced the fact that we don't believe that the 90s bubble is a useful guide. The investment backdrop that we're in today is unusual. I think deflation remains still a very excellent risk. I think policymaker support is very unusual. Quarter of the world's bond market trade with negative yields. So, of course, tech stocks are going to be more expensive than they were 10 years ago, but they remain miles away from where they traded in the late 90s. And on a relative basis versus the S&P, at least, we trade today at 1.2 to 1.3 times the market multiple, as compared to more than 2.3 times at the peak of the 90s. However, on the next slide, you'll see that there are pockets of exuberance. Some of the software stocks look expensive. Again, unusual investment backdrop, wonderful assets, M&A that's supportive, but not much room for disappointment. And that's why we've been reducing our exposure there. And similar on the next page, the spread between winners and losers looks reasonably wide right now. And so we've been reallocating from some of the more expensive names into reopening trades in e-commerce, travel-related assets, robotics, and some of the semiconductor companies with exposure to electric vehicles and 5G particularly. Nearly finished. If you flip to the next page, quickly on AI. So when we're done with pandemic and when we're done with the cloud, which is roughly, we think, about 30% penetrated as a percentage of overall computer workloads, what next? And of course, the answer is AI. About 3 years ago, we launched an automation and AI product because we saw the long-term potential associated with this group of technologies that will ultimately permeate through everything. And something that Gartner called out many years ago. Why now? Because in the end, we have huge amounts of data that's being created in the cloud natively, or the interactions that we are involved in are just multiplying at a rate of knots. The cost of computers collapsed. We have dedicated silicon built for AI workloads. We have cheap storage, and yet only 1% of the world's data is currently stored and analyzed. And again, that's why we're still scratching the surface. Now, on the next page, key moments, of course, in AI in our lives. The one that I think many people of my generation remember will be IBM beating Kasparov. It was a big deal. And more recently, the IBM supercomputer that beat human competitors using natural language on the Jeopardy game show in 2011. Again, ancient history now. But what's fascinating is, again, this idea of man versus machine or human versus machine, never far from our thoughts. And on page 27, you'll see that since then, AI has not just reached human levels of capability, but superhuman levels. So there's no point playing Go anymore, because in 2016, AI, neural networks from DeepMind, now Google, solved for that game. Likewise, in 2017, that same neural network was repositioned to learn the game of chess. And it did that in 4 hours by playing itself. And with that ability, was able to beat the world's greatest chess program, Stockfish. Again, lots of detail, but trying to imbue with the idea that AI is happening as we speak. 2018, the same neural network, was turned and sold for a game called StarCraft, a popular online game from Activision. And then last year, a massive achievement, a neural network from Carnegie, Facebook, sold for poker. So don't play poker against a computer because it's been solved. And that was done, and by the way, in live play, no supercomputer that takes up your room, just the power that would have been on your laptop was able to beat 12 human players over 10,000 hands. The next page, I think, is also hugely interesting. A few years back, we got to a stage where the error rate in language processing reached that of a human. 2017, we show here, I think it was Google that first managed to get to a level roughly in line with the human level, which are around 4%. But since then, we've moved on hugely. And these TLLGs, they're hard to say, have reached now 98% levels of accuracy. And that's why, by the way, your Amazon machine works so well, and why Siri works so well. And we're beginning to see how AI can move into areas like conversational commerce, can actually correct our work. We're moving at the edges into real-time translation. So huge potential to come from natural language processing. And on the next page, you're also beginning to see how AI can create content. So this is a screenshot from a game that was built by NVIDIA to celebrate the 40th anniversary of Pac-Man, my favorite retro game as it happens. And this game was built with no underlying game engine, just a neural network watching hours and hours of human and simulated play and creating the game in its image. This is a portrait made by a neural network, a GAN, that competed against another neural network by first being force-fed thousands of portraits and then creating portraits, and then the other neural network being paid effectively to detect if it was real or not. One of those went on to be sold at Christie's for $500,000 in 2018. And on the right, this incredible experiment of using the GPT-3, one of the most incredible neural networks, to build that content that was written entirely by computers. And again, scratching the surface, just a reminder that AI remains, we're still very, very early in what looks incredibly powerful as a medium-term driver. I think we may nearly be there. Last slide, I think, Oliver. Oh, there goes Pac-Man. Oh, no, not quite. And so today, where can you see AI? You can see it at Facebook, a platform built on data. You see it at Netflix, where the thumbnail that you select is personalized for you based on your habits, your tastes. You only have 2 seconds to choose, pretty much, as a human. Look at Spotify. It's Discover a Weekly playlist built on 100 billion, effectively, data points a day. Data platforms, the ability at Axon to take millions of hours of policing footage and be able to automatically redact and review footage. It changes the face of policing. And of course, there's Uber, 100 petabytes of data and a business built on that data and things like journey optimization, billing, dynamic pricing, and so on. So to conclude, which I hope is the next slide, the disruption that we've seen in tech, the backdrop for technology investing didn't begin with the pandemic. The pandemic has been an accelerant for sure, and things will settle down in some categories and not in others. But the disruption that began before will persist long after. And in the end, it's because the internet, like steel and like electricity before it, is a general purpose technology around which everything gets recreated and reimagined. And so it's possible that we'll see rotation in the broader market away from tech, and every dog has his day, but the pre-COVID world has gone. There is no returning to that world, in my opinion. And I think rather than a snapback, we should all expect very profound change in the years ahead, driven by technology. And in the not too distant future, AI will continue to infuse our space. Sorry if I've overrun. Hope it was useful. And thank you very much, JM Finn, for the time.
Ben, thank you very much indeed. Let's hope that a bit of artificial intelligence will help some of us get to grips with the new normal in due course. I'm going to move straight on. Just a word to the delegates. If you're struggling to see things like some of Ben's squiggles, then as a reminder, this will be placed on the website in due course, so you'll be able to look at them in more detail. Right, we're going to go straight into the next speaker, which is Natalie Berg, and I'm delighted to have Natalie with us today. She's an expert in retail, and to help us get to grips with a lot of the change that's happening on our high street, she's very kindly offered to come and talk to us about the changing shape of the sector. So, Natalie, the screen is yours.
Thank you, Oliver. Thank you for that introduction and for the opportunity to be here today and share with you my views on retail and, more importantly, its direction of travel. We're going to cover a lot of ground in 15 minutes, and I think we'll be picking up on a lot of the themes that Benjamin already introduced around disruption and how COVID is really an accelerator of a lot of the trends that we were seeing before the pandemic hit. So if we can move on to the next slide, please. So I also write for Forbes, and last year, is actually almost to the day, about a year ago, I put out a series of predictions because we were entering a new decade. A couple months later, global pandemic hit, which completely upended shopping habits and our everyday lives. So what is really interesting, though, is that a lot of these trends are actually still very valid. And if anything, they've only been accelerated. The one exception here is this idea of peak Amazon, because if anything, I think COVID will have delayed this idea of peak Amazon, and if anything, Amazon is proving to be the hands down undisputed winner from the pandemic, and plenty to say around that, but we'll move on for the sake of time. So before I get into retail, I want to talk a little bit about the consumer and how COVID has changed our habits, our expectations, our demands from retailers as consumers. We have to remember that we are 21st century shoppers, right? So we are used to having the world at our fingertips. We're used to shopping on our terms, not the terms dictated to us by the retailer. So when the pandemic hit, it was a pretty huge shock to the system. Everyday certainties dissolved. The ability to go to work, to send your kids to school, access to healthcare, access to groceries on shelves at the supermarket, access to toilet paper. So everything sort of just changed overnight, as we all know. And I won't spend too much time dwelling on the past, but I think the significance here is that this will have a lasting impact on consumer behavior and our mindset going forward. So I think that the pandemic has humbled us as consumers, and it's made us appreciate the most important things in life. And how does that translate into sort of what we want and expect from a retailer? There's two things for me. I think firstly, a very obvious point here is that we've learned to lead truly digital lives. So again, pre-COVID, our lives were very digitally influenced, but now our lives are overwhelmingly digital. So, you know, we've learned to work online, homeschool online, exercise, socialize online, all kinds of things that we could have never dreamed of pre-COVID. And in the future, I think we won't really know where the physical world ends and the digital world begins. The other important thing from a consumer perspective, and then we'll move on to retail, is that the pandemic has really shown a light on the environmental impact of consumption, something we've always sort of known about. It's always been the elephant in the room. I think it's awakened many of us to the realities of climate change. And one of my Forbes predictions was that we would see a shift, again, this is pre-COVID, that we would see a shift away from mindless consumption towards more mindful consumption. And I really think this idea of conscious consumerism is about to burst into the mainstream, which will have huge implications on retail. I think there will be opportunities, just very briefly here, in the resale, repair, and rental economies, which are really the perfect antidote to fast fashion. Just Black Friday a couple weeks ago, we saw retailers like Pretty Little Thing offering dresses for 8p. And I think we're all recognizing that that just doesn't sit right with us, with many of us as consumers. So I think we can expect big changes in the future. So we have to point out here that the retail sector is no stranger to disruption. Retailers have had Amazon breathing down their necks for the past decade. You know, pre-COVID, Amazon was the primary catalyst for change. And so I think in many ways, retailers were actually well-equipped, unintentionally well-equipped to deal with a global pandemic because they've learned to be agile, they've learned to fail fast, they've learned to, we've seen a lot of these pandemic pivots, if you will. And so in some ways, they were well-positioned for when COVID hit. So something that I keep saying is that Amazon may have been the primary catalyst for change pre-COVID, but COVID will finish what Amazon started. I think this is so important. You know, they say that necessity is the mother of change, and we've certainly seen that within retail. I think going forward, digital transformation is no longer optional. If anything, digital transformation is about to become supercharged. So if we move on to the next slide, we'll talk a little bit about the trends that we will see accelerated due to COVID. So very briefly here, you know, it's very clear to see that COVID has accelerated the rise of e-commerce. You know, we are spending a lot more time at home, and also when stores are physically forced to close, we have no choice but to shop online. So Benjamin alluded to the fact that I think it was around 20% of people tried shopping online for the first time. That behavior, I think, will stick. If we look at the data here, this is ONS retail sales data, online sales as a percentage of the total market. Up to, I should point out, this is up to October 2020. In a couple of weeks, we'll have November data, which will include the second lockdown. But as you can see, I've included my predictions from November onwards. Now, what's interesting here is that around a decade ago, e-commerce accounted for roughly 5 to 6% of the total market. Just before COVID, it got to 20%, which felt like a real milestone. And then in the space of 8 weeks, it jumped up to 1/3 of total retail sales. Now, again, that's because we didn't have a choice as consumers. We had to shop online, and we were all sort of rushing to buy, you know, toilet paper and hand sanitizer and whatnot. And I think that, you know, that kind of erratic behavior has since leveled out. But the key point here is that consumers will have had a taste for online shopping, and I think that this will stick. At the same time, I do think we're desperate to get back into stores, and I'm going to come on to that in a little bit more detail later. But I really believe that this is a once-in-a-lifetime opportunity for e-commerce retailers to take things to the next level. However, I don't see e-commerce getting to sort of 50% of the market. I know some analysts are a little bit more bullish here. We also have to bear in mind that as e-commerce, as the market grows for online retail sales, so do the costs. That's something that we don't talk about probably enough. And I think we might see in the future things like, you know, the reversal, not an easy thing to do, but the reversal of same-day delivery. You know, we've spent the past decade getting used to ever faster and free delivery. But I think there's an opportunity for retailers to retrain consumers to accept no rush delivery, which could be packaged as green delivery, for example. So I think that retailers are recognizing that this kind of growth really isn't sustainable. I mean, you only need to look at the messaging from retailers right now, right before Christmas, the most important time of the year for retail. Everyone is encouraging shoppers to collect from store, to shop early. They're trying to spread out that demand, and encourage shoppers to shop online when there's no other choice, but also look to stores as a critical point, as a critical part of that fulfilling that e-commerce order. And something I keep saying is that the future of e-commerce, in my view, is actually stores. Stores really do play a critical role. So I think that COVID really is the ultimate e-commerce catalyst. If you look at what happened in China after SARS, we saw the sort of explosion of e-commerce there and digital payments, and that was something that really stuck. We saw Alibaba launch Taobao, we saw JD.com launch, all these huge e-commerce companies really began on the back of that epidemic. So I think it'll be interesting to see what happens here in the UK, in a market where e-commerce is already very well established. A lot of people, especially in the more vulnerable category, will be wondering if stores are really worth it right now, and we'll come on to stores in a little bit more detail over the next few minutes. But we have increased connectivity. We've got 5G coming in. There will be no return to the old normal. We've already heard a little bit more about how, workplaces will be more blended in the future. And, we hear from big bosses saying it just doesn't make sense to have thousands of people grouped into a very expensive building in central London when actually we've all learned to work remotely. So I think just like the future of retail will very much be blended, I think that's certainly the future of work as well. Hyperlocal retail is going to boom. Again, this is something that was gathering momentum pre-COVID, but we're all spending more time than we probably ever imagined in our homes, and also we want to support our local communities who have been there for us during lockdown. So I think we will see sort of in tandem with the growth of e-commerce, the growth of hyperlocal retail is a real opportunity at last to really invest in our local high streets and reconfigure them to really take them into the 21st century. The second trend that I think we will see an acceleration in is the convergence of physical and digital retail. So there's two key things here for me. Firstly, whether intentional or not, we're seeing an acceleration in technology that facilitates a safe shopping environment. So contactless payments, for example, but perhaps what's more interesting is this idea of scan and go technology. So being able to, as Amazon says, just walk out. In the future, it won't feel like we're shoplifting to just pick something up off the shelf and walk out. Again, this was pre-COVID. This is retailers responding to the threat of Amazon and the pending launch of Amazon Go. It is coming to the UK at some point, and a lot of retailers were trying to get ahead of Amazon by investing in their own scan and go technology and checkout-free stores. M&S has just launched, I think it's just last month, they're rolling out scan and go technology to every single one of their UK stores. So this isn't just a fad, this is something that very much will stick post-COVID. The other really important point here is click and collect. Again, click and collect is nothing new for the UK high street, but what I found really interesting during the pandemic is that retailers that traditionally wouldn't embrace things like click and collect, independent retailers, Aldi, for example, is rolling out click and collect to a couple hundred stores. My local library, my local fish and chip shop, everyone is embracing this technology that enables customers to order online and collect in store. So again, with when you're forced to evolve, you certainly do. One other point around click and collect that I think will be really important for the future and how the high street evolves in the future is this idea of collaboration. So one example, Sweaty Betty teaming up with Waitrose to collect their, so shoppers can place an order online with Sweaty Betty and collect it in their local supermarket. Very important during lockdown when only essential retailers were allowed to stay open. So that's something we'll see much more of in the future as well. The digital world will become more immersive. So here's a rather embarrassing picture of me trying on lipstick virtually with Pinterest's new app. Social commerce is coming. It was coming pre-COVID. It's certainly coming now. We saw during lockdown, Facebook launched Facebook shops. I think the next decade, e-commerce experiences, the previous decade, e-commerce experiences were all about reducing friction and making it as easy and seamless as possible to order online and get stuff delivered to your house. The next decade will be about making it more enjoyable, more fun, more immersive, add more discovery and excitement. And that's where social media really comes into play. Also the use of augmented and virtual reality, like Diesel, for example, and I think Balmain as well. There are a few other retailers trialing virtual showrooms. So you don't have to just type in little black dress and have 40,000 search results come up. You actually can feel as if you're walking into a store and trying stuff on. And very quickly, the last point I want to make here is that one thing that retailers had to do during lockdown that will stick again post-COVID is connecting online shoppers with in-store staff. I think retailers did a really brilliant job of making that connection. And there are other apps that were already out there pre-COVID, like Hero, for example, that were doing exactly that. It was more limited to the luxury end of the market. And again, this is something, this idea of this white glove service being democratized. I think this will really become mainstream, and we'll see this greater blurring between physical and digital worlds. We have to talk about the doom and gloom though, right? COVID will accelerate the demise of what I call mediocre retail. So we all know that there are a lot of retailers out there that have failed to adapt, that have failed to evolve. You only need to look to last week's news to see what's happening with Arcadia and Debenhams. This is, in my view, retail Darwinism on steroids. And now that in the current climate, there really are no second chances for retailers that fail to adapt. You know, we were using the word unprecedented before COVID, talking about the level of change in the industry. And I think, you know, COVID will, for some retailers, be the death knell. It will be the final nail in the coffin. The strong will emerge stronger. As I said, Amazon will be the big winner, but we have to recognize that we have to brace ourselves for more challenging times as the sector reconfigures for the digital age and simultaneously deals with a global pandemic. However, the positive stuff now, I think the future of retail in a nutshell is fewer but far better stores. So I think that there is an opportunity for retailers to redefine the physical space. And this slide is a presentation in itself. I mean, there's so much to say. But I heard Andrew Lloyd Webber talking on the Andrew Marr show last weekend. And what he said, talking about the return of live performances and the return of theater, really resonated for me as in terms of how shoppers will be coming back to stores. You know, he said that there's pent-up demand and shoppers and theater goers will be coming back in droves as soon as they're able to. And I truly believe that's what we'll see in retail. You know, online shopping is great and we can expect to see continued growth, as I showed in that previous chart, but we are social creatures. We're all craving to get back to a sense of normality. Retailers have had to quite literally put the touch and feel of shopping on hold to keep us all safe. So, you know, going into a shop now where you've got to wear a mask and sanitize hands and you can't really try stuff on, it's not the same experience. And I think that it will come bouncing back. I think late 2021, realistically, is when we'll see a revival of the physical store. And retailers really need to start thinking about this now, about how they reconfigure and repurpose their stores. But I do believe that this century will have its own roaring 20s, if you will, and the physical store will be all about human touch, emotional connection, discovery, and community. And I think that high touch, sensory driven experience will come bouncing back into two physical stores. So that's the something to look forward to, I think, late next year. But we'll just wrap it up with this final slide, which is the most important word in retail at the moment: agility. I think there's three key traits for retailers that are looking to survive and thrive on the back of this crisis. Agility goes without saying. You know, there will be no return to the status quo, and you know, now more than ever, retailers really have to evolve. Resilience is the second word for me. You know, we do have to brace ourselves for more challenging times ahead. But purpose is the third word. And I think this is really important because, you know, our values as consumers have changed dramatically in the past year. And I think that, you know, consumers will be looking to align themselves with brands whose values reflect their own. I think that's going to become increasingly important in the future. But in summary, you know, opportunities will emerge from this crisis. And I think now more than ever, it's essential that retailers embrace change. So that's my whirlwind tour of retail. I'm conscious we've covered a lot of ground and always happy to answer any questions in a follow-up. Thank you.
Natalie, thank you very much indeed for sharing your thoughts with us this morning. Now, in the interest of time, I'm going to move swiftly on to our final guest speaker today, who is part of the management team of Baillie Gifford's flagship investment trust, the Scottish Mortgage Investment Trust, which their website kindly reminds us has nothing to do with mortgages and is global rather than Scottish. So whilst Tom Slater and the team invest across multiple disciplines today, he's going to talk to us this morning about the future of transport.
Well, it's great to be here with you today. I was just thinking about the last time I was invited to speak at this event. I think it was at the Oval about 18 months ago on a fabulous sunny morning. What a difference it was to be sitting in a cupboard off my bedroom talking to you today. I guess maybe as a starting point, I suppose the key facet of Scottish Mortgage to understand is that we are very long-term growth investors. But isn't technology changing so fast that it's hard to be very long-term when you think about growth? Well, if you could flick to the next but one slide, Oliver. So yeah, one back. That's the one. What I want to argue this morning is that change can actually be quite predictable, but investors make the mistake of spending a lot of their time trying to predict things which are impossible. What will the level of the stock market be at the end of next year? I don't know. What will economic growth be next year? Don't know. Interest rates, same. 2020 is really a great example of that. If you'd given me perfect foresight into the events of this year, would I have accurately predicted stock prices? No. And the example I've used, the picture for you, is oil prices. So the dark purple path shows the oil price over time through to 2015. All the other lines are the World Energy Organization's forecasts at that point in time. And you can see the path of that purple line is completely unrelated to those forecasts. Using these types of data point to drive your investment strategy is challenging. And there are lots of smart and extremely well-paid people trying to predict these variables already. So we don't waste our energy. Should we give up? Next slide, please. I would say no. There are changes going on that are much more important than fluctuations in interest rates or economic growth. And it's those that determine the opportunity for companies. So the example I've used here in this picture is the cost of generating energy from solar panels. It's declined at 20% per annum for the past decade, following an almost perfect exponential decline. I couldn't find a chart for the cost of storing energies in batteries, but it follows a very similar curve. So the price per kilowatt hour of storage has fallen about 16% for every doubling in global battery capacity. And I could add in Moore's law and semiconductors. I think Ben Rogoff did a slide showing that, or the bandwidth of communication networks. And none of these trajectories rely on predictions of technological breakthroughs. This is the application of scaling capital along with incremental innovation in existing industries. And that really is great news for investors. These are predictable long-run trends. And it just leads to the question, what does the world look like if computers are 50 times faster, if energy is, for most intents and purposes, free, if energy storage is ubiquitous? Next slide, please. So my topic for today is transport, but I think the combination of these improvements in hardware along with advanced software is transforming a number of existing industries. We've seen in retail with the growth of Amazon, as our previous speaker talked about. We can see it in the media industry, where Google and Facebook have come to dominate the advertising industry. But we're now seeing it in lots of other places, from health to education. So any one of those could have been my topic for today. But let's drill in on transport. I'm going to talk about some trends we've observed in our holdings. But the key point is to say that this isn't based on imagination. It's not some theoretical far-off future. It's based on companies which we're currently invested in. We have a 10-year investment horizon, and we expect these things to happen in that time frame. So next slide, please. So I'll start on passenger vehicles. Tesla has been the largest holding in Scottish Mortgage for a while now. I think it's high profile enough for me not to have to dwell on. NIO is a Chinese electric car company which has also been successful in scaling production into what we think will be one of the key markets for electric vehicles in the future, China. And I think there are three trends that are going to define the future of the passenger car. The first is electrification. And the argument here is pretty simple. Electric cars are better than combustion engine cars. They are faster. They are safer for their occupants. They are safer for pedestrians. They don't lead to local air pollution in the way that gasoline cars do. So this isn't dependent on people with an environmental agenda buying the products. It is simply that they are better, and that government legislation is going to force the issue anyway. So electrification will happen. The second important trend is towards autonomy. And what you need to understand about autonomy is that actually it's really quite easy to get a car to drive itself autonomously. Carnegie Mellon won the DARPA Prize in 2007 with an algorithm that could drive a car 97% of the time. What's really hard is that last few percent of accuracy. With billions of miles driven each year, you can't get it wrong 3% of the time. You can't get it wrong 0.1% of the time. You need to be 99.999% accurate. For society to accept this, it needs to be an order of magnitude better than the human driver. And we're getting there. Huge progress has been made. It's just that we can't perceive the difference between something that's 4 decimal places or 5 decimal places of accuracy. We're getting there. And the final trend in passenger vehicles is ownership. In a world of electric autonomous vehicles, we may still have private cars, but at that point they become income-producing assets if we want. We only use our cars 3 to 4% of the time, so owning them will become an unnecessary luxury. Indeed, ownership may well move to the lowest cost of capital. If you want concrete evidence of that, there's a very timely announcement overnight that one of our autonomous driving companies, Aurora, which is run by the professor from Carnegie Mellon who won that DARPA autonomous driving challenge back in 2007, that he bought Uber's advanced technologies unit and signed a strategic agreement to provide artificially intelligent drivers to Uber in the future. So next slide, please. Whilst passenger cars grab the headlines, there are interesting things going on in commercial vehicles. So I've pulled out 3 key trends. The first is software. When we think about transport, we think about hardware. And that mattered when your vehicle had 2,000 moving parts. Engineering mattered. But in the future, it's less relevant. Actually, software is much more important. We've touched on the autonomy. The bottom left picture here shows one of the vehicles being developed by a holding in the delivery company Neuro. These robots are electric. They replace human drivers in doing deliveries within neighborhoods. They're small, light, and that makes the challenge of autonomy less taxing than it is for passenger cars traveling at high speed with human occupants. Human drivers are a significant component of the cost for last mile delivery, so these vehicles could shepherd in a new era of fast, cheap, convenient delivery. And they recently raised $500 million to turn that into reality. The energy density point enables what I show in the top right, which is one of Zipline's delivery drones. These fixed-wing aircraft have a delivery range of about 100 kilometers. They drop their delivery by parachute to a 4-meter square drop zone. And the first applications have been for this technology have been in blood delivery in sub-Saharan Africa. That company now operates at national scale infrastructure. It controls about half of the blood supply in places like Rwanda and Ghana. This is happening today. And it's made possible by the declining cost of batteries, the declining weight of batteries, the use of software to do all of the flight controls, navigation, integration with air traffic control. And what started in the medical sector and in sub-Saharan Africa will begin rolling out with Walmart in the US next year. So this technology is coming to the skies near you soon. And the final point is that networks might be more important than individual vehicles. On the bottom right-hand side is a picture of Convoy's trucking app. There's a huge inefficiency in matching freight loads to vehicles in the trucking industry. It's still predominantly an industry that's based around brokers ringing hauliers with orders. But there was a huge change 5 years ago because the growth in the penetration of smartphones suddenly meant that drivers had a device in their cabs which could relay all sorts of data about their location, their speed, their availability. And what Convoy is doing is using machine learning to drive efficiencies into that road haulage market. Instead of sending loads one by one, the software can batch them together. It can route trucks more efficiently to match the freight that's available. And there are just some massive savings to be gained from doing that. So that's what's changing in commercial vehicles. The final place I want to go was to the air. So last slide on this. So flying cars were once the stuff of imagination, science fiction, but the declining cost and weight of batteries, smart software, cheaper, lighter electric components takes you to the 2 aircraft shown on the bottom half of that slide. These are vertical takeoff and landing electric vehicles produced by Joby and Lilium, both of which we own. And we think these services are going to be very attractive. People were afraid of helicopters because they're noisy, because they have very fast-moving components just above your head. But these vehicles are quiet enough to use regularly in cities. Some of them have no exposed moving parts. They have several engines, so they aren't vulnerable to individual failures. And these are going through certification processes today with the Federal Aviation Authority. So there isn't a radical new set of inventions required. The predictable cost curves I talked about earlier take them right into the domain of affordable commuter services, and with a far better customer experience than most currently would enjoy. The final area of trial I want to touch on is space rockets. Now that was the preserve of governments for the past few decades, but that's changed. We own 2 space rocket companies, SpaceX and Relativity. And the crucial thing to understand here is it's all about cost. Space hasn't existed as a commercial market because it's too expensive. And the first thing that's changed is software. So many of you will have seen SpaceX's rocket boosters returning to Earth and landing after launching a rocket. That's a capability enabled by advanced software flight controls. It reduced the cost of launching by an order of magnitude. Just imagine the cost of plane travel if you had to scrap the aircraft at the end of every journey you made. Now, the second cost reduction is around manufacturing. And this is the interesting thing about Relativity Space. It doesn't have a factory like you might see for Boeing and Airbus with humans bolting hundreds of components together. Instead, it prints them in a 3-dimensional printer. And constructing a space rocket in this way may represent a very significant step down in the cost of manufacturing for an item which has very high material costs, but also very low volumes. And the applications of low-cost space travel are plentiful. You know, we've all heard about Musk's ambition to send humans to Mars. They catch the headlines, but from communication networks to making semiconductors to doing very, very fast intercontinental travel, the application of spacecraft are manifold. So next slide, please. Just a final thought before you go enjoy your lunch. It's not one from me, it's from Microsoft founder Bill Gates. I know the future I've talked about here may seem a little outlandish, but it's driven by well-established predictable trends. It won't be here next year, but as an investor, you should be thinking about the next decade, and all of this and more will be possible on that timescale.
Tom, thank you very much indeed. That is all very exciting stuff. But now, as our last speaker, we're going to come back to the here and now. And while we've heard from different investors about specific themes, we asked James Ayling, who's part of our research team at JMFin, to zoom out and try and put what we've heard into context from a wider macroeconomic perspective. That's to say, give us a little bit of, discuss a few areas that he thinks we as investors should consider. So, James, if I may, over to you.
Today, following a number of really interesting and thought-provoking presentations from our guest speakers, as Oliver mentioned, I wanted to use today's presentation as an opportunity to really step back, zoom out, and look more at the macroeconomic landscape from a top-down asset allocation perspective, to think about where the global economy may be heading into 2021 and beyond. So this year, the coronavirus pandemic has presented us all with an unprecedented challenge. And just like anyone facing a problem, authorities have had to delve into their policy toolkits to try to mitigate the impacts. For central banks, there are two main tools available, one being interest rates and two being quantitative easing. Let's first look at interest rate tools on the next slide. So in my mind, prior to 2020, the US central bank, the Federal Reserve, was consciously trying to rebuild some monetary policy firepower. We can see from the light blue line in this chart that having slashed interest rates to low levels in the aftermath of the global financial crisis in 2008, they were keen in 2016 to begin weaning the US economy off emergency low interest rates. In 2 years, we can see from this light blue line that they gradually notched rates back to 2.5% before having to revert course in 2019. So that was even before the coronavirus pandemic, and that was due to a weakening global economic backdrop and trade tensions between the US and China. The Bank of England, represented by the navy line in the chart, attempted a similar course of action at the end of 2017, albeit it had only managed to scale back interest rates to 0.75% before having to quickly cut interest rates again. In Japan and the Eurozone, the green and red lines respectively, central bank interest rate policy has been clamped around the 0% level since the start of 2016. And this has meant they haven't had much scope to cut interest rates any further in this crisis. So overall, where does that leave us in 2020? Well, in my mind, this chart shows the dramatic and coordinated interest rate policy cuts by central banks, including China, represented by the orange line. Altogether, central banks, in response to the COVID-19 pandemic, have eased monetary conditions. Yet importantly, I think cutting interest rates from an already low base has had less impact on the global economy during this economic downturn. Weak economies crippled by the COVID-19 pandemic implies that now is not the time to raise interest rates. Instead, as per the title of this slide, interest rates will likely need to be kept lower for even longer to support the global recovery. Given this, let's now turn to the next slide to consider the other tool that central banks have available in their policy toolkit. That is quantitative easing. And this is really where central banks use financial assets to add liquidity into the financial system. As a representative example, I thought we could look at the US central bank, given its primary importance to the global economy. This chart allows you to see how much the central bank's balance sheet has expanded as it has conducted asset purchases over time. In the immediate aftermath of the 2008 global financial crisis, the Federal Reserve conducted 1.4 trillion of asset purchases. Yet, this time around, in direct response to COVID-19, the Federal Reserve conducted 3.1 trillion of asset purchases. That is more than double the intervention of the last downturn. And this action really is significant in historical context. It takes the central bank's balance sheet to 35% of GDP. That is a level the Federal Reserve notes has not been seen since World War II. This level is also broadly similar to action by other major central banks, like the Bank of England and like the European Central Bank. So, given, as I said before, that interest rates are already at rock bottom levels, this quantitative easing tool is likely to be what central banks continue to use, particularly over 2021, to provide that highly supportive monetary policy backdrop. However, if most tools are already out of the toolkit and in use, we should start to think about what other tools might be available. I'm not convinced monetary policy alone is enough for the global economy to recover. It's already done a lot of what it can do to ease conditions. Instead, we really do need to hand the baton over to governments who have expanded fiscal policy with higher spending to support healthcare systems, provided business relief, and for individuals, a combination of employment and unemployment support. In my mind, governments cannot afford to lift off the spending pedal at this juncture. Governments can deliver growth, and create jobs through the likes of infrastructure spending over the medium term. Additionally, their support can help businesses and consumers regain much needed confidence after the COVID-19 pandemic. Ahead, I think we do have to consider that governments adopt a more fiscally loose stance than post-2008, as with limited firepower left in monetary policy, fiscal austerity could be a policy mistake. So now let's turn to inflation. In the short term, I don't think we will see any strong inflationary pressures. The global economy needs to recover from a period of weakness. At present, there is both spare production capacity and spare labour capacity available. With this excess supply set against current weak demand, there is likely to be little upward pressure on prices. And this is what the chart on your screen shows. The blue line maps the market's expectations for a certain point in time for US inflation into the future. What we can see is that the market doesn't expect US inflation to be rising anytime soon. And this agrees with my point earlier about no catalyst for rising inflation in the near term. However, this chart attempts to capture what the market is forecasting for inflation to be over the medium term. My own personal view is that over the medium term, inflation could actually come back to surprise us. The combination of expansionary monetary and fiscal policy does have a stimulatory effect on the economy, and if left for too long, it could cause the economy to overheat. So far, therefore, we have had a look at interest rates, quantitative easing, government spending, and taken a look at inflation. On the next slide, we've therefore tried to bring this all together to consider how we can incorporate these insights into our investment positioning. As the economy moves into a phase of gradual recovery in 2021, I believe this provides a more supportive backdrop for equities relative to fixed income for a number of reasons. Firstly, equities should benefit from a recovery in earnings as businesses and consumers normalise their spending, saving, and investment habits. Secondly, for those companies with debt, the lower for longer interest rate outlook we spoke about gives those companies the opportunity to refinance that debt at lower borrowing costs, which is likely to improve further their profitability. And my third point is around inflation protection. As mentioned before, I believe central banks are likely to keep their foot on the easing pedal, and therefore they're likely to tolerate higher levels of inflation even into the medium term. As traditional government bonds don't provide outright protection against higher inflation, investors may want to position themselves more towards equities to receive some level of inflation protection, or instead, you could look towards inflation-linked government bonds to help mitigate some of the medium-term inflation risks. This then opens up the question of where to position ourselves within equities. We have seen over the last 5 or 6 years that growth stocks have outperformed value stocks, even on a total return basis. I think the major driving force of that outperformance has been the lower for longer interest rate environment. And with interest rates staying tethered to the floor, because central banks are likely to tolerate higher inflation, I'm not convinced that we will see a sustained rotation out of growth equities into value equities. There could be a short-term shift, and we've seen a bit of that over the past month or so to reflect some optimism of economic recovery. But I do believe that longer term, investors should retain more exposure to growth stocks versus value stocks. And this gives rise to a predicament. Typically, value stocks tend to pay higher dividends due to lower growth prospects. Therefore, in this instance, we need to think about how investors can generate sufficient cash flow from their portfolios while still being exposed to lower yielding growth stocks. It might therefore be the case that investors need to take more of a total return mindset towards their portfolios. I'm aware that ideally, investors prefer not to incur capital gains tax. However, in this economic climate, this may be needed in order to manufacture that income from a portfolio whilst retaining exposure to, in my opinion, the higher returning growth stock opportunities. Now, I'm very aware that if you increase your portfolio's exposure to equities, you do so and make your portfolios more sensitive to economic risk. And we need to be aware that high risk exposure could come from growth disappointing or if we face policy mistake. That really reinforces, in my mind, the need to stay active and dynamic across our asset allocation decisions. Certainly, we can't overlook the near-term Brexit deadline. This presents us with both business and macroeconomic risks to consider. As it stands, without a deal being agreed, the UK transition period will end on the 31st of December and the UK will be subject to a hard Brexit. There are, though, a number of potential outcomes, and the two main scenarios worth highlighting, in my opinion, are a free trade light deal or a no deal Brexit option. Whilst I think the probabilities of each of these outcomes has become closer over the past few weeks, I still think, on balance, the UK and EU are likely to reach a free trade light deal. This trade deal is expected to be similar but more expansive than Canada's deal with the EU. So we could see some short-term disruptions, but I expect them to be fairly short-lived. Instead, in the deal scenario, I see sterling likely to strengthen a little more from where it is today. The UK economy is likely to pick up steam as uncertainty dissipates, and I think more domestically focused companies may well benefit more than internationally focused companies. If, however, we face the hard Brexit no-deal outcome, then I'd see a shift to an arrangement with tariffs and quotas on goods, more disruption caused by both border checks and destination of origin checks, and less chance of a financial services agreement. This, I believe, would cause sterling to weaken. We could see short-term foreign capital leave the UK, and I suspect a negative economic hit to UK growth that would cause the recovery from COVID-19 to take longer. So UK equities would be under pressure versus their global counterparts. And whilst large internationally exposed companies may outperform more domestically focused UK companies because they're able to translate a bit of their overseas earnings into sterling, which helps as a hedge, I still think investors will dislike the uncertainty and favour equities outside of the UK. Additionally, I think we should think carefully about exposure to UK manufacturers that export a lot of goods to the EU, as they could well be the most exposed. So the next big milestone is likely to be the EU summit that starts on the 10th of December, this Thursday, where a deal would need to be signed off by EU leaders. Overall, I'm optimistic that politicians on both sides of the negotiating table will, despite much headline quarrelling, seek to reach a mutually beneficial deal and remove uncertainty. This will allow the EU and UK to revert attention back to recovering from the COVID-19 pandemic into 2021 and beyond. So to finish, I hope you found today's macroeconomic insights useful. And if you do have any follow-up questions, please feel free to reach out via your JMFin investment manager.
James, thank you very much indeed. All it leaves me to do, with running slightly over time, for which I apologise, is to say thank you very much to all our speakers for joining us this morning and to giving us their time and sharing their insights. And thank you to all of you, our clients and contacts, for joining us. As I mentioned at the start, a recording of this whole event will be available on our website. And if you think it's relevant, please do feel free to share with your friends and family and networks. In the meantime, send any questions you may have to your investment managers. So many thanks and goodbye, and a very happy and safe Christmas to you all. Thank you. Bye-bye.